Do we feel that in Asia that there's the regulatory landscape that is evolving to support the private credit growth?
It is, albeit more slowly than, say, EMEA in the US, which had rapid evolution in the regulatory environment post-GFC, but Asia is slowly moving in that direction. I think also just the speed of capital deployment and the flexibility of capital that's required in the region has also become far more complex and sophisticated, which lends itself more to the non-bank lending market than, say, the regulated bank lending market.
But is it becoming fast becoming a bit of a scramble or a land grab, if you like, given that it does seem that given the more mature markets of Europe and the US, and therefore the opportunities presenting themselves in Asia and elsewhere in emerging markets, that global players are all sort of fighting to get in the door? Does that create a lot of competition?
It's certainly competitive in the more mature markets of, say, the US and EMEA, where the private credit managers are very long established, they have proven track records and deep relationships developed over many, many years. I think Asia's at the early innings of that, and it benefits from all the learnings and lessons that managers have had in other parts of the world. Having said that, although I see a lot of private credit managers here in the region, I don't yet see a lack of discipline in the lending that's being done. I think managers are coming in cautiously. They recognize these are new markets with very bespoke requirements, and they're acting accordingly. So I don't see that there's froth or any kind of super competitiveness which would lead to bad deals or mispricing in the market yet.
Sachin, how compelling is the Indian market as an addressable private credit opportunity? Because that's clearly one where we've seen the rise of shadow banking, the rise of NBFCs as the traditional bank lending has pulled back, creating those funding gaps and creating those opportunities.
Absolutely. India is a super exciting market, especially given the growth of the economy, the rapid development of the middle class, and all the associated infrastructure that they will need, both in terms of hard assets, soft assets, commercial assets. The one thing that's kind of throttling back growth, I'd say, is the ability to get capital in and out of the country in an easy way, and also just certainty over the tax and regulatory environment. I do expect the government definitely recognizes that and will make strides to ease investors' concerns in the years to come, but at the moment that's moving quite slowly. So I'd say we need at least another 5 years before you start to see significant flows of external capital into India.
How would you characterize, when you look across the private credit market in this region, Sachin, default risk? Where are spreads looking the most dicey? Are there any warning signals when you lift the hood on this market? And is there any risk that this private credit boom could turn into a bust?
So the spreads are certainly very tight in the public markets, and we've seen that across the world. And private markets have followed suit. They are typically, in pricing in the private markets is benchmarked to public markets, for good reason. I think there's a big difference in that in the private markets, you get compensated for the complexity, but also the ability to provide very custom bespoke solutions. And that also allows you to protect the transactions and structure deals in a way that confers downside protection to both investors, but also the borrowers as well. So I don't yet see froth in the private credit markets per se. I do think pricing has come down, and that's just tracked public markets more broadly. But I don't yet see a lack of discipline in the transactions being done.
How should private credit investors navigate the China market? Or is it just way too challenging at the moment when you consider that the Achilles heel remains the property developers and what's happening there?
I think it's too early to say at this moment. I think everyone's got their eyes on the property market and is watching intently to see what happens there. And that will really lead the rebound in credit markets more broadly in the region. I think it's difficult to lend to other sectors without having confidence over the property market, just because it's such a large part of the economy and drives overall sentiment, but also corporate performance.